Is Upstart a buy or a sell? Let's get started with the model. This is a mid-cap company, $7 billion market cap. They're trading at $77 a share, and they have 93 million shares outstanding. Upstart offers personal, home, and auto loans. It was founded in 2012, headquartered in San Mateo, California. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have positive free cash flow in 2021, negative in 22 and 23, back to positive in trailing 12 months. This type of company is a little more difficult to value, so free cash flow isn't always the best estimate. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was positive in 2021, but negative after that. Revenue is a sales for the company, and that was highest in 2021, $850 million. It fell to $500 million in 2023, up a little bit, up 9% in the trailing 12 months. So the numbers are all over the place. We estimated 4 years of future free cash flows. We also estimated a terminal value. It's all cash flows. Past year 4, that's $5 billion. We discounted those numbers back to today using weighted average cost of capital. We got a value of the company of $4.3 billion. We divide that by 93 million shares. And we get a calculated stock price of $47. They're trading at $77, so they're trading at a 66% premium. It's a sell according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are 71 companies in the same industry as Upstart, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't need to spend much on CapEx, only $8 million. Their debt-to-equity ratio is 1.7. That means for every dollar of equity, they have $1.70 of debt. They don't pay a dividend. Most companies do pay a dividend. Western Union's close to 9%. They generate $95 million of free cash flow. Ally Financial is nearly $4 billion. And OneMain is $2.6 billion, and OneMain is smaller in terms of market cap. Their price multiples look pretty weak. They're trading at 11 times book value. Ally is number 1 at 0.8. They have negative earnings, so we can't look at their PE. Western Union is the best at 5.5. Trading at 75 times free cash flow, the worst on this list, and trading at 13 times revenue, one of the worst on this list. They only generate $550 million of revenue. Most of the companies below them generate a lot more revenue, and they're smaller in market cap. So it does seem overvalued according to their price multiples. We can't look at their 5-year annual revenue growth rate. They haven't been public that long. They're trading at 77, pretty close to their 52-week high. So you might want to wait this one out till it comes down a bit. If you put $10,000 into this company when they started trading, at one point you would have been at $100,000. At some other points, you would have been negative. It's a true roller coaster ride. But if you're still holding on, you'd be at $21,000 today. That's a 22% annual return. To summarize, I have them trading at a 66% premium, ranking 3 out of 10. I'd probably avoid this company. Would I buy it short term? 2 out of 10. Long term, maybe 4 out of 10. Ratios 3 out of 10. They look pretty overvalued according to their ratios. Financials 1 out of 10. Pretty weak financials. Everything's going down. Let's take a look at their 10Q. Here's their income statement. This is the third quarter of 24, third quarter of 23. Total revenue $160 million. Last year $135 million. Most of their revenue is from fees, $168 million. Then they had $41 million of interest income. They have interest expense, and then fair value adjustments of their loans. That's how you get your net revenue. Their operating expenses are higher than their revenue, so that's why they have an operating loss of $45 million. Their biggest expense is engineering and product development, $65 million. G&A, $60 million. Marketing, $43 million. Customer operations, $39 million. They probably need around $400 million of revenue to break even. They did have a gain of $33 million from the extinguishment of debt, so their net loss is better than last year. They have a net loss of $6.8 million. Last year, $40 million. And they added 6 million shares. Last year they had 84 million, now they have 90 million. Let's look at their balance sheet. They have $2 billion of assets. Their biggest asset are the loans, $1.2 billion. About $470 million of cash. Goodwill is the premium you pay when you acquire another company. Their liabilities are $1.4 billion. Most of that is debt, a little over $1 billion of debt. That's how they fund the loans from the debt. About $400 million of debt is from a warehouse facility. $660 million from convertible senior notes. So if the stock price goes up enough, the holder of the note will convert the debt to equity, and that means this company will not have to pay the debt. They have $378 million of debt due in 2026, $430 million due in 2029. When you take their assets minus their liabilities, you got the equity, $635 million. They raised $918 million from selling their business, and they lost $280 million from running their business. Here is a statement of cash flows for the trailing 9 months. They do have positive operating cash flow, $34 million. Last year, $300 million. In their investing section, they had a cash outflow of $89 million. It looks like they gave out $121 million. It looks like they provided $121 million in loans. They received $78 million in loan payments. In their financing section, they had a cash inflow of $137 million. They received $529 million from debt. They paid $515 million from debt. And they issued $165 million of securitization notes. Securitization notes is debt that's backed by an asset, like a pool of mortgages or a pool of auto loans. Let's look at a stock on Simply Wall Street. Its last price, 77, 7.2 billion market cap, up 5% in the past week. It's up a lot in the past year, 70%. They IPO'd at the end of 2020 at $42 a share. Within a year, it hit $383. I hope you didn't buy it at those levels because you'd be down a lot right now. Its lowest point was $12.98 in May 2023. Its lowest point was on May 1st, 2023 at $12.98. And it's up quite a bit since that point. Probably a good 300-400%. Simply Wall Street's at $2.20. Simply Wall Street is at $2.20. They say the stock is pretty much worthless. 12 analysts price this stock at $58. They also say it's overvalued. Here's their revenue since 2017. It was only $67 million. It got up to over $1 billion in 2022. It's down about 40% since that peak, currently at $600 million. Here's their debt since 2018. They pretty much had no debt in June 2021. The peak was $1.2 billion at the end of 2023. Now they're a little under $1 billion. Equity at $600 million. At one point, equity was higher, but now it's lower than the debt. And they do have a good amount of cash relative to their debt. About half their debt they have in cash. The CEO's salary was $360,000 in 2019. Now it's $460,000. Total compensation $7 million. Tenure as CEO 11 years. And their employee count has gone up a lot. It was 273 in 2019. It got up to 1,900, but now it's down to 1,400. And the ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, Sao Paulo Bolsa, and the Buenos Aires Stock Exchange. So if you want to learn how to build a discounted cash flow model, click on the video in the top right corner. Thanks for watching.